Welcome back to another video. Today I wanted to briefly talk about the retail sector. Some of the retailer stocks such as Target, Walmart, Abercrombie & Fitch, Best Buy have all been absolutely crushed this past week. The main example being Target. Target's down around 30% for the week. I want to explain whether or not we can buy this retail dip, what caused such a dip, and whether or not we can benefit from this. So Target posted a 52% drop in profit from the first quarter, missing earnings estimates by around 30%, but they blamed supply chain issues as well as inflation to the constant pressures against the top and bottom lines of Target. Target fell 25% in one day, making it its worst day since 1987. This dragged many other stocks, including Costco, Walmart, Best Buy, Kroger down with it, down 5, 6, 10% as well. So why did Target drop this quarter since inflation, hasn't really hit America yet? Inflation has, but not to the retailer. So they blame their 52% drop on supply chain for this quarter, but they also said they had to uh, cut back from demand and supply issues from the COVID time. They said right after COVID there was a lot more demand and a lot more people were going to Target, but now since that has died down, they're getting less people in the door, which is already concerning because we do expect inflation and these supply chain issues to continue to grow. That's why we saw such a dramatic pullback of 25%. In my personal opinion, I think Target does have a little bit, more room to go down. Many people might say, hey, it's at a 12 or 13 PE, maybe at even a 10 or 12 forward-looking PE, pays a good dividend of 2.4%. Why do you think it'll go down further? I think that Target and Walmart and these retailers might actually face, um, future losses, and I really think that that you might actually see retractions in revenue and profits for these big uh, department stores, and I think it's going to be something we haven't seen before. And I think there'll be some retailers that benefit and some that don't. I think Target will not be, a beneficiary of that. I think Target has more discretionary spending compared to Walmart. So Walmart also suffered a similar fate, though. They're also down 21% in the past 5 days. They also had earnings which were kind of mixed. Expected was 139 billion, actual was 141 billion. They missed their earnings though at $1.30 with an actual of $1.48. They also cited supply chain issues as well as inflationary pressures of them rising the cost of goods. They also said that if this continues, they will not be able to grow year over year. However, they did cite that they do expect growth to be around 2% year over year, while Target is expected to lose year over year. So I think that's kind of interesting to note. However, the valuations between these two stocks are actually quite different. Walmart trading at 25 PE, while Target's near 12 or 13. So the entire retail sector, especially hypermarkets and supply chain and department stores, are down well over 10-15% for the week. So how can we take advantage of that? I think the pain for some of these stores will continue. I think you have to be very selective in which stocks, can go down. For example, I think like clothing department stores, where it's not, not really that grocery related stocks will suffer a lot. For example, I think Abercrombie and Fitch, a retailer, which is not even close to its COVID lows, can suffer quite a bit. I think they'll definitely be in losses. They do expect a positive EPS, but I think they may miss. So I'm looking to buy some put options on Abercrombie and Fitch. So the problem with Target, Walmart going down so much is that the break evens and the premium for these puts are absolutely crazy. You're expecting a 10 to 12% drop, and yet the premium is still pretty high. So I think I'm gonna go with the $30 puts for around $3, $3.35 for Abercrombie and Fitch. I do see it, kind of going down, but I do expect, dead cat bounce because 8 weeks in a row of red. But I do see it, near a $20 stock. I do think it's overvalued, even though the PE is at 6. because I do see this as a declining revenue business. So if you look at the earnings, there's some stocks here which are more related to the retail sector, like Best Buy. We have Nordstrom as well. I think Best Buy has a lot of negativity priced into it because it is already down so much without its earnings being released. It went from 100 to 70, and I think they pay stable dividend. They've come down quite a bit from its highs, and they're approaching that level of you know pandemic lows. And I think this is a stock that you don't touch because Best Buy has surprised in the past. They have shown good guidance too as well. They're expecting $1.63 per share. They have very low multiples for a growing company, and they also pay a dividend. So, yeah. But there's also one or two other earnings plays that are coming up. I think Dollar Tree would be, a good one. I think this swings really hard in either direction. As you can see, it has been chopped off a little bit due to the bad earnings from Target and Walmart. However, it is still up 19%. But again, premiums are expensive. I would suggest learning a bit more about put options, the break evens. But I am looking at the 135 135 puts. I do see it, coming down quite a bit. But I can always be wrong, so we should obviously play it safe. Overall, I think this industry is going to go into a little bit of a downturn in the next year or so. But I do see some value coming up. For example, if Walmart does fall below $100, I will definitely be taking a look at it. Walmart's been always a constant behemoth, and always tends to go up, and they always grow, and they're the biggest revenue company in the world. I think it'll continue to do that, but with inflation worries and cost of goods going up in supply chains, I think it's the perfect storm. I think you can make a decent amount of money if some of these stocks do fall 10 to 20%. Personally, my positions would be more towards, again, the clothing retailers like Abercrombie and Fitch, American Eagle. I'll also be looking at Build-A-Bear Workshop. I think this stock might be prime candidate. It has not moved at all in the past year. It has a big short interest, and its pandemic low is still quite low. So that's all. I think people should buy the dip on certain retail stocks, and for certain stocks, they should let it go. Overall, I think this industry will take a dive in the next 6 to 12 months. And yeah, hope you enjoyed this video. Please leave a like and subscribe.